You're listening to the Maple Tree Capital podcast, where we put retail first, institutions second. Please note that all opinions shared today are that only of Maple Tree Capital and no other party. Please do proper due diligence and seek proper financial counsel before making an investment decision. Nothing presented today is investment advice. You are listening to the Maple Tree Capital podcast. I'm your host, Henry Invests on X, founder of Maple Tree Capital. It's time for What's in the Treehouse, where we talk about some of the moves we've made in our portfolios at Maple Tree Capital, in Jonagold, our growth fund, and Heartwood, our more moats and pricing power fund as well. So Q2 just wrapped up a couple of days ago, and we wrote our shareholder letter, which we published on our X page at Maple Tree Cap, and of course on my page at Henry Invests as well. So you can go ahead and read that for a very thorough, in-depth look at our investment philosophy, the moves we made this quarter, the progress that we made this quarter in building both of these brands. So I'd really highly encourage you to read that. And I've been writing these letters for Maple Tree Capital for almost 2 years now, going back to the Q1 of 2024, and our fund. I started our fund in really 2023. So there's a little bit of history on the performance here, and happy to say that it's been outperformance for the most part. So Jonagold, the growth fund over at Maple Tree Capital, has returned over 400%, 402.81% since January 1st of 2023. That's a 91% CAGR, which is pretty extraordinary. Obviously that's going to temper a little bit here, but that 91% CAGR is well above our personal goal of 35%, and crushes the NASDAQ, who's only returned about 98% during that same time frame. And that's really possible given our low AUM, if you will, right? The portfolio is not multi-millions of dollars, so we're able to do a lot of extreme concentration and onboard a lot of risk. And also, as time has gone on, we've gotten a lot better at managing that risk by selling calls and taking some off the top when things get a little exuberant. So, for example, last week, we sold calls on Lemonade in about the middle of the week when it started to peak up towards $48. I just felt like the sentiment on X was very large, and it was approaching that $50 level, which was a level it had previously topped out at during the first squeeze back in February. And selling weekly calls at a point in time where the stock is up 8% 10 minutes after open. I'm not saying you have to do it in full size, but in little pieces, it has proven to be successful, and so we were able to net a decent amount of profits from that. And of course, we're not bearish on Lemonade by any means. All the profits that we make from trades like that, we just reinvest into our core holdings. But I feel like gotten a lot better at the risk management over time. And I think everybody talks about 2023 to 2025 has been a great time for growth investing, and it happens to coincide with when it launched the fund, and totally agree with that. But I do feel confident enough that should I start to see a pivot in the performance of the market, or growth starts to underperform, that I can adjust to that. And I think Q2 is really cements that for me, given that, early in the quarter, we were still coming off the tariff fears and the market was puking. And at that point in time, I had realized, okay, it is time to be buying, right? Did not sell calls, so did not allow my mindset to turn very, very bearish after the market had fallen so far. So it's able to hold on to a lot of my core positions, which have doubled since then. But if you go back to Q1, the end of Q1, slipping into Q2, that was a lot of bearish momentum, and I sold a lot of calls during that time, as well as bought a lot of shares too. But I just feel like my confidence in having to grasp over how to trade this portfolio is growing. And, I'm sure the market will test me on that as it does. Take the baby out with the bathwater, I guess. But we'll have to see what happens. But for now, the performance has been great. I have a lot of conviction in our four names: Upstart, Lemonade, Grinder, and Hims. They all continue to do very, very well and execute strongly. So I'm not too worried about where this portfolio is going to be in the future. Actively managing it, continuing to watch it, and always looking for new additions to it as well. But very strong quarter. This quarter was arguably one of the best across Maple Tree Capital in history. So Jonagold returned 42.32% this quarter. That's after the fund started down 17% the first week in. So really a remarkable turnaround. Of course, the market had a remarkable turnaround as well. Heartwood, our other portfolio, continues to underperform the broad market. It's returned 44.13%. since inception, which is January 1st of 2023. During that time frame, the market has done well. Returning for the S&P 500 a little under 68%, and the Nasdaq 98%. The Dow Jones 39%, almost 40. So we're beating the Dow, but that's not too much of an accomplishment. About 25% or so away from beating the S&P 500. So that's clearly a lot of underperformance that I've been trying to work through. Touch on this in the letter, some of the sort of the mistakes that we made. But Q2's performance for Heartwood was the best on record. So that means a 26.28% return this quarter after the fund initially started down by about 15%. Strongest quarter on record, and that brings the portfolio's CAGR up to almost 16%, which is below our goal of 20%, but also somewhat respectable, despite a lot of losses, but certainly some improvements to be done there. I think the biggest trade that we made in Heartwood this quarter that I'm really proud of is we sold Krispy Kreme, which was a really a very bad decision to get into that one. And we just talk about it extensively in the letter. Sort of that book, Best Loser Wins, reframed our mindset, and it's like, hey, like the market, if it is trending in one direction, it's very clear why it is doing that, right? And I just feel like we held on to the Krispy Kreme narrative a little bit too long, even when maybe the fundamental performance wasn't getting a lot better. So cut it, and shares continued to fall after that, and the McDonald's deal, which was basically the contingency of our thesis, actually after we sold not too long after, went away, citing like unit economic issues. So just a total disaster all around. I think they want to be it's really a logistics company and shipping company, which is puzzling, considering I think if they just outsourced that part of the business, the margins would be a lot higher as more of an IP play. With the brand of Krispy Kreme. But, lessons learned on that one. When we sold it at $3.22, a huge loss, but we did buy MBIS, Nebius, at $31.35, which has ballooned over 60% to over $50 now. So that was a large net positive on the performance this quarter, and I think those are sort of the trades that we're looking to make, is getting away from theses where the story appears to be more broken than we initially thought, and just going to sort of switch that over to names that we have more conviction in now, or that are compelling new ideas. And I think that's more of a mindset shift than anything, and it's something you develop over time, and just working through that very, very slowly. But I'm optimistic about where Heartwood can go in the future. So for Q3, we expect Heartwood returns of 7 to 9%, and Jonagold returns of 12 to 15%. Some very strong momentum to start the quarter. I think that may wane for a little bit. I think there might be some sort of scare. There's a lot of macro uncertainty going on, and then maybe pick up near the end of the quarter as well. So optimistic, but cautiously optimistic, and will adjust should that trend start to change. But some of the Q2 highlights, traveled to New York City for Upstart's AI Day. That was a lot of fun. Further developed the Upstart Trustpilot Index, UTPI, and the revenue prediction model, Upstart IQ. Sold covered calls, realizing some gains despite trading against a rising market, and grew the Henry Invest X account to over 4,400 followers, which exceeded the guidance we gave of 4,200. So for Q3, really, Maple Capital, we're focused on continuing our research and fine-tuning of our covered call strategies. Want to grow the Henry Invest X account to 4,700 followers, and also want to grow our AUM as well. So that is a very successful quarter for us. Highly encourage you to go through and read our shareholder letter. There's a lot of visuals, very visually appealing, and it's very granular. So if you're really curious, almost a public audit of our performance, my performance, Henry Invests, right? Like I think that's sort of the brand that we're trying to build, is a lot of authenticity. And if you read the Q1 shareholder letter, where the market was not performing very well, and tariffs said puke, you'll see a lot of language that I'm very proud of today. That was the thinking that we had during that time, because during that time, Upstart had fallen from 97 down to 35. It's at $72 today, so it's rebounded sharply. But during that time frame, we wrote like our conviction in Upstart is higher than ever, and we actually increased our Upstart position by 38% in Q2. So I think we're making the right moves long term. We ended the letter in Q1 with "This too shall pass." It has. I'm just very optimistic about what Maple Capital has in store for the future. You are listening to the Maple Tree Capital Podcast. It is time for the Macro Pulse, where we review some of the week's biggest macro implications, news drops, releases, and more to give our listeners a very composite overview of what is going on and driving the market. So the market was a short holiday week last week, and the market closed at all-time highs, and that was really driven off a couple of things. Number one, Thursday's hotter than expected June jobs report. So payrolls came in at 147,000. Much higher than the 110,000 estimate, which really obliterated the odds of a near-term rate cut. So July rate cut odds fell substantially to just 7% from 24% the day prior. And September rate cut odds slumped to about 68% when that was all but certain. I think the odds were over 90% just the day prior. So, a couple of things on that, right? Obviously, a stronger economy is net positive. That's good news. But rate cut odds were up and driving some of the, the strength in the market as a lot of people were moving to risk on assets in anticipation of these rate cuts. But, if rate cuts are coming because an economy is weak, that is not necessarily really a good thing. So a stronger jobs market, I think, for most investors is a good trade-off in exchange for higher rates. But, the pressure is on Powell and on the Fed to cut rates. And Trump does want to get in there and replace Chair Powell with a Fed chair that he believes will absolutely cut rates. So I think the political pressure is really mounting up. Then we'll have to see what the Fed does in July. I think if they don't cut in July, and there's still a chance of that, they're certainly going to hint at a September cut coming. And really the problem with what's going on with the Fed is because they think right now that tariffs are going to sort of reignite a wave of inflation that we haven't yet seen. But the problem is, in waiting for that data, how long are you willing to wait before it starts to materialize? And what Trump can do, and I think this is what he may do, is push the July 9th tariff deadline back. And the further he pushes back these tariffs, he sort of forces the Fed's hand because the Fed can't afford to just sit around and wait forever for tariff inflation to come in. So if Trump just delays that, he'll make the Fed look worse and really sort of almost force their hand and prompting them to cut. So I think that's a situation that may be upon us. It's possible, and Trump has said, hey, if you cut rates and inflation starts to come back, you can raise rates. Not necessarily the approach you want to take, but it's certainly possible that could be the monetary policy path that we go on. But I think almost everybody is calling for rate cuts. Whether they're just or not is one thing, but the sentiment and the political pressure are really mounting on Powell. And despite the strong jobs report, I do think rate cuts are coming, although maybe that will be pushed back to September from July. So, like I said, non-farm payrolls came in really a lot stronger than expected, 147,000 versus 110,000 estimate. The unemployment rate also slipped to 4.1. I believe it was 4.2 prior. So more people are out there with jobs. Average hourly earnings increased 0.2% month over month and 0.3% year over year. This was strong enough to dent easing bets such as rate cuts, but not hot enough to reignite inflation fears. This is why the market really rallied off of the jobs report on Thursday, was because it really showed a strong, resilient economy with decent wage growth, but not enough wage growth where you sit there and say, okay, inflation is coming back. And the unemployment rate being down is good. I definitely don't want people unemployed, but like I said, that does hamper the rate cut odds. ISM manufacturing ticked up to 49. That's lower than 50 for those who don't know how to read that. Anything below 50 in ISM survey for services or manufacturing. Anything below 50 means contraction, and anything above 50 means like production or output. So you normally want those to be above 50, albeit in this sort of market, if it's a little less worse than expected, that could also be a positive too. So that ISM manufacturing came in at 49 with prices paid at 69.7. Services PMI rebounded to 50.8. So there is some strength in the services sector. Maybe that's something to do with consumer spending habits and how they're spending. Manufacturing could be a pullback on corporate spending. There's a lot of potential implications there. Markets are now looking for the June FOMC minutes, which are coming out on July 9th, and the July 9th reciprocal tariff deadline. That's something that I just mentioned earlier. Depending on what Trump does with that deadline, it could definitely be a market mover, especially for names that have heightened exposure to tariffs or to the consumer, in a sense that those tariffs may continue to be passed on. So Shark Ninja was a stock of the week a couple of weeks ago. We talk about it later in this episode, and that's one that would probably move off a headline like that. And then, of course, also the big, beautiful bill passes the House, and a lot of implications there for tax credits. I know EVs sort of took a hit, solar as well. That was just passed over the weekend, so we'll have to see how the market opens on that tomorrow. But the implications of that are big, and it may take time for the market to fully digest and price in the implications of that bill. So that's going to be a top watch this week, and volume, I think, will be the story on what's going on there. In Europe, the Euro area flash CPI nudged up to the ECB's 2.0% target, while core stuck at 2.7%, reinforcing expectations of a final 25 basis point cut in September, as central banks around the world are lowering their rates, while the Fed remains about 200 basis points above sort of our peers. Very interesting, and once again, two very different stances on monetary policy. And Powell, in his testimony last week, cited the reason for that is the United States economy is just so much stronger than other nations that he believed the higher rates were justified and not as much of a damper on the economy as they would be for maybe some of the other markets. In China, official manufacturing PMI stayed in mild contraction, 49.7. And even though the Caxian, and I'm not 100% sure on that pronunciation, returned to expansion of 50.4, it all comes down to, right, China, do you trust the data? China right now is going through a big political revamp. Xi Jinping, the leader of China, is sort of kind of being pushed out of his political power influence, pushed out of the circle a little bit by some of the elders to a more pro-business friendly approach. And I think that's just because the Communist Party's adherence to communism, if you will, has put a large damper on their markets and set them back from the United States in big, tangible ways. So there seems to be some more free market narratives going on in China, and if you follow a lot of China insiders, such as David Zane, you'll see that Xi Jinping is maybe losing a little bit of his political power. So the takeaways for what we're doing over here at Mapletree Capital is really we're in a bull market. It's very clear. We had a 20% plus retracement from all-time highs in April with a rebound that was almost vertical and has now eclipsed the previous all-time highs to new all-time highs. So that's a very good sign of a bull market. The market's optimistic about what's going to happen. I think the tariff fears may have been a little bit overblown. And now we're kind of sort of pivoting back to that soft land narrative where the Fed's cutting rates into modest or really mildish inflation, which could create a scenario with rate cuts and a little bit of accelerating inflation, which would be like mad, very, very bullish for equities. So I think that's the situation of the market is starting to price in. So I'm going to continue to ride the wave and sort of just see when the sentiment changes. I think I read a book, Best Loser Wins, a couple of weeks ago, and I think the biggest takeaway on that is do not think that you're smarter than the market when you're trading. So if the market is clearly in an uptrend, don't fight it. Don't fight the trend, right? You just got to ride the waves. And if the market starts to reverse course, there will be plenty of time to get into that move after you have confirmation of that as well. So that's sort of my philosophy, our philosophy over at Mapletree Capital. Just trying to ride the peaks and troughs of the market. And right now, everything is very bullish. All indicators are bullish. Lots of stocks are breaking out. There's a lot of positive volume. And while, yes, it does definitely seem like some stocks are getting a little bit bubbly, I'm not going to proactively react to that just yet. So that is the macro pulse for today. Welcome back to Stock of the Week. This week, we're actually going to be reviewing a previous stock that we talked about 2 weeks ago in our first episode, and that is Shark Ninja. So we talked about Shark Ninja, a little bit about how they were maybe more immune to tariffs than the broader market believed, as they did a lot of planning to sort of absorb those tariffs during the first Trump administration. Also, we took note of the economy that we're in, where a lot of consumers are sort of looking to selectively spend, and when they spend, they want great quality, and they want very durable product, which fits very well into Shark Ninja's brand. And so when we talked about that stock, Shark Ninja, shares were at about $90. Just 2 weeks later, shares have risen to $107, up almost 19%, and really making a breakout on the technicals here for the chart above all major moving averages, and getting very close to pushing all-time highs at around $123. So it's a very big move for Shark Ninja, and I think it warranted us coming back and sort of revisiting what made us bullish about it, and then talking about what we're going to do maybe with the stock in the future. So Currently, Shark Ninja trades at about 34 times earnings. Certainly nothing too extreme, especially given that they're going to compound their earnings over time. And that it's also somewhat of a fast grower, believe it or not, and a household name. Those are the things you want to warrant higher PE multiples. But despite that, on a forward basis, they're only a little bit over 23 times earnings, with a price to sales of just under 3. So Shark Ninja, let's dive into the financials a little bit. We talk about all these improvements, but how do we quantify it, right? Well, total revenue in 2024 hit 5.53 billion. That's up from 3.7 billion in 2022. And since 2022, total revenue has grown at a 22% CAGR. So that's very, very high top line growth rate. Also during this time, and I think that's what makes it a little bit more impressive, for 2024, research and development expenses hit 333 million. That's up from 209 million in 2022, a 26% CAGR. But net income and earnings during that time frame as well hit 439 million in 2024, up from 232 million in 2022, growing at over 37% CAGR. So in a time when Shark Ninja's top line is growing by 22%, their research and development is growing by 26%, their net income or their bottom line earnings are growing by 37%, and their EBITDA as well hit 767 million in 2024, up from 408 million in 2022, a 37% CAGR over that time frame. So what we're seeing here is a company that's growing their top line profitably, while at the same time increasing their research and development expenses, which is going to position them well down the line to roll out new products that will support the top line as well. So they're very prudent on their expense management, and they're coming out with new products that are growing very, very well, allowing them to invest more in research and development, and that's trickling down to the bottom line in a material way. If you take into account the fact that a little bit what we talked about earlier, that the stock is really not all that expensive. You have an ROIC of near 20%. Stock-based comp as a percent of revenue is just over 1%. And you get sort of the makings of a very, not abundantly cheap, but a very conservatively priced, or certainly not extremely expensive stock that's growing rather nicely. And if you were to take away any recession or any like geopolitical concerns with tariffs, and you would have a company that is really firing on all cylinders. And I think that's the narrative that the market's been painting, right? With rate cuts coming up here, certainly maybe by September. If not, Trump has said countless times that he's going to appoint a Fed chair that will lower rates, which should be good for Shark Ninja. And so I think, we're seeing the market sort of start to front run that a little bit. The July 9th tariff deadline is this week. That will be a very big deal. We'll have to see what happens there. If that deadline is not extended, it's possible that Shark Ninja could retreat. And we're up pretty big on our position here. Granted, it's not huge size. But depending on what happens with July 9th, if there's some volatility in the stock, Shark Ninja, that is, we may take just early profits. But it's definitely be one that we keep on our radar and continuously watch. Would also love to be able to set up a valuation model for a bear, conservative, and bull case, so can kind of get used to maybe trimming the tops, or things of that nature. Also trying to get up to 100 share count lot, a nice round lot, so that you can sell covered calls on it if it starts to reach the upper bound of our valuation threshold. But those are some of the things that we're thinking about with Shark Ninja. It's really just progressed so well over the past couple of weeks. And it's also, at the same time, this is not retail really driving the move. This is a lot of institutions. So there's an indicator on TradingView for those who are following along called Smart MCDX. And I have to get credit to Aaron Gray, who's a fantastic young investor like myself over on X, who pointed this out to me. And essentially it just maps out what sort of volume is institutional, what is traders, what is retail, and it puts it in color codes, so that's very easy to see. And the recent move in Shark Ninja, according to this indicator, take that for what it is, has been driven a lot by institutional investors, and that would make sense. We're starting Q3, so there is some rebalancing going on, but I'm very optimistic about where Shark Ninja can go. Like I said, their products last a very long time, yet you can still constantly buy new products every couple of months, I would say, because they just get more and more niche, and that's what their customers want. There's a lot of TikTok marketing going on for that as well, and so I think that's very impressive. The last thing I'll say really on Shark Ninja is if you Google Trends, which is a great resource, Shark Ninja search inquiries are breaking out close to all-time highs. Not quite as high as where they were near the holiday season of last year, but for those who want to follow along or do it themselves, if you just chart out where they've been over the past 12 months, they're getting near all-time highs. Past 5 years, they're getting near all-time highs. And if you look at 2004 to present, they are basically at all-time highs. So this is a brand that has a lot of relevance still, certainly not going away. And the financials tell that story. They're increasing their margins while keeping their R&D spend very steady. The valuation is definitely somewhat reasonable. They don't have a lot of debt either. Debt to EBITDA ratio of just about 1. Current ratio, so that means current assets over current liabilities, of almost 2. So they do have some immediate liquidity. And I think this could be very well be a great winner over the future. Wish I got in at the IPO a little bit earlier. It's not going to be a super fast grower. I don't expect it to be a very volatile name like it has been, post the Liberation Day, if you will. But very, very interesting name. Want to keep tabs on, and I wanted to bring that to your attention and talk a little bit about more about the updates that we've been seeing on that. I know some people had commented and asked for an update on it. So that's sort of where we are right now. Holding our shares steady and just kind of waiting to see what happens with the tariff deadline next week. But the fundamentals and the brand narrative of Shark Ninja seem to be doing very well. We're going to wrap up this week's show and every show with the retail mailbox, where we answer questions submitted by you. So this week's question comes from Greg, who asks, what is the single biggest piece of advice you would give to a new investor who wants to actively trade and beat the markets? So this is a great question. I'm probably not the best person to answer it, just because I don't have a ton of experience in the financial markets, and it's really a daunting game over long periods of time. But for me, I think, what I would recommend is developing your own internal mental framework. So that means not really listening to what other people say, not in like a narcissistic way, but just in a sense that you want to develop your own process. And when you're learning, right, like babies become versions of their parents when they grow older, right? Because parents are nurturing them, teaching them how to go through life, all that sort of stuff. And I think that's important as an investor, but you don't want to let your judgment be sort of clouded by what others think too much. I think for me, my journey has been a lot of learning by myself, falling on my face, getting back up, falling on my face again, and just kind of stumbling my way through it. And I think, there's no shortcut to getting to where the Warren Buffetts are. You have to sort of like fail, learn from that failure, and continue to go forward. Like, I don't know, like if somebody's driving and they're always texting on their phone, right? Well, they're going to continue to text on their phone until they hit that lamp or that pole, and they total their car. Then they may be like, okay, I'm going to stop texting while I'm driving. Same thing with investing, right? Like you're going to have somebody who knows the advice of, day traders, you can lose a lot of money. And if they're on a hot streak, they're just not going to listen, and they're not going to take that in until they start to lose money. And so I think the only way that you can progress really as an investor is by going through the motions yourself, learning and failing by yourself. I think that makes you very powerful, because you know that you have ultimate responsibility over all of your actions, and it results in a lot of self-accountability, and the traits that you have as an investor and how you think about your philosophy, what you're doing, and your strategy and your process are very, very important, just as much as understanding the basics of a financial statement or something like that. So that would be my general advice. Other than that too, you don't want to not listen to other people. You want to objectively think about things and inform your own philosophy. That's all. So lots of reading too. A lot of great books. Books are so special because you get like the life's work in some instances of a very smart individual put on pages in front of you. You can just read and absorb everything that they've learned that they are eager to share with you for a low price. Reading a lot of books and just learning about what other people have done in the past, what's worked for them, objectively analyzing that, and then internalizing it and putting that and implementing that into your own philosophy. So that would be a little bit of my advice. Although I'm certainly not the best person, I'm in no position to come at you as like, oh, I know what I'm doing, because I don't. I'm still figuring it out, but hopefully that's helpful. And thank you everybody for listening to this week's Made Butcher Capital podcast, and hope to see you tune in next week.